it's the first of the month again. It's the 1st of June. And I always like on the 1st of the month to have a look back on my portfolio to see if I've met my target for the month. So this is my SIPP pension portfolio. So I'm only a couple of years from retirement, so my target is quite low. My target is for 6% per year, which is just above the money market fund that I've got, which works out at 0.5% per month. So I have hit my target this month, but only just. And what it does show here is that if I had all my money in the All World Fund this quarter, or this month at least, I would have tripled my profits for the month. But I also know that would have been a riskier bet, really. So here's how I get to my 0.5% target. So if we think about the All World shares, we're typically looking at an expectation of around 9% per annum, which works out monthly at 0.75. For a money market, you might be looking at 5.4% per annum, which works out at 0.45. My target is very near the money market because I'm very low risk at the moment in terms of my appetite because I am quite close to retirement. Therefore, I've put my target at just above the money market at 6%. If I was 10 years away from retirement, that would be 7%. If I was 20 years away from retirement, I really would be looking to get between 8 and 9, maybe even higher. But because I'm so close to retirement, then I would like to minimize the risk, and therefore most of my investments is in the money markets. Generally, it's good advice to buy an ETF or a group of ETFs and leave it. Don't touch it. Don't go there. So why am I checking mine every month? Well, I'm quite active, really. I'm trying to squeeze as much as I can out of my pension pot just before I do retire. And I'm guessing because you're here watching pension videos, you're probably of a similar mindset, really, in that you don't want to just leave it alone, and you are more interested in actively managing what pension funds you have. So I hope you found this useful anyway. So if you've heard my outro, then thanks for listening. And if you haven't, then here's probably the most important bit of investing advice you'll hear on YouTube. Don't buy or sell shares in a company based on what someone on YouTube tells you. The big Wall Street analysts have large teams of professionals with access to vast amounts of data on every single listed firm. There are no YouTube gurus who know better than them. Use YouTube to find interesting bits of information on companies that you may otherwise miss. And when you find something interesting, do your own digging and see what the analysts in the big firms are saying. Never invest more than you can afford to lose, and don't expect to get rich quick. If you are interested in my background, I come from 16 years in risk management with PwC and Deloitte. I've never been on a trading floor in my life, but if I had, it wouldn't give me the edge on the big firms because they have big teams and masses of information. So don't look for a guru with an edge. Look for information on companies you're interested in. And if you're looking to invest a large amount of money, don't put it on individual stocks. Choose an index fund. The All World Index is a representation of all the stocks in the world. And if one company goes broke, then the index won't even move. Whereas if you've only invested in that one company, then you may have just lost your pension. Keep it fun, keep it affordable, and subscribe to keep getting my updates. Thanks.